We have to start with the big topic, the simplification process of the bank. You announced a few months ago that you were embarking on this mission. I think about 6 weeks ago during the earnings call, you've outlined some of the cost savings and the benefits that you hope to achieve. I guess just give us an update where you are in this process. What have you achieved up to date?
Yeah, thank you, David. So if you recall, we announced organizational simplification back in October, end of October, and then we set it in place as of the 1st of January, and we've given additional details about it in February. Just a few points to note. First, we have great momentum in the business. Our strategy is working. We're delivering the results. You've seen our 2024 results. They're strong. I have to thank all my colleagues and obviously the trust of our customers to be able to achieve them, but the momentum is with us. Second, we've demonstrated that we can be disciplined. So we've been disciplined in the way we allocate our cost, we allocate our capital. We've demonstrated that this discipline is ingrained and we will carry it forward. And third, we also demonstrated that we have confidence in the business because, among other things, we've given a target for our returns on tangible equity for the next 3 years, for every year at mid-teens return, which is based on the underlying confidence we have on the trajectory our business is taking. So with this backdrop, it was necessary for us to think, okay, where can we drive the next areas of growth, but also where can we drive the next areas of efficiencies? And one major finding is that we haven't been a simple organization. Well, we've simplified what we do. We haven't simplified enough in our past how we do it. And if you want, by simplifying what we do over the last many years, it was just the right moment now to simplify how we do it. And it had to come through in the form of organization simplification. What we reported also, David, is that we will be able to drive about $1.5 billion of efficiencies without an impact on our revenue. So that's about 8% of our staff cost without impacting what we do in terms of the revenue generation capabilities, just by being more efficient. The primary purpose of this organization simplification is to be simple, to be agile, to be able to adapt to a changing world, to be able to be adapting to changing customer needs, to make decisions faster, to be faster to market, and we're on the journey at pace to deliver the simplification.
Right. And can I ask you maybe about some of the numbers you brought up there? So I think it's $300 million in cost savings you're targeting this year. It's a further 1.5, I think, going into the fiscal of next year. But you're also, I think, recognizing $1.8 billion in upfront costs because of the restructuring taking place. Is it an accurate way to describe the situation that after 2 years or so, and not to mention, of course, there's a longer term component to this, that you're financially neutral, just given those two numbers seem to be coincidentally identical?
So what we announced is we will be incurring about $1.8 billion of cost, essentially severance cost.
Okay.
That the saving, most of the decisioning for that will take place this year. Most of it will take place in the first half of the year. That the benefits will start materializing this year, where the $300 million benefit will come this year. That the benefits will materialize in full by the end of full year 2026. So the full year 2027 will benefit from the full $1.5 billion saves that we're targeting. What we also committed that these will be permanent saves going forward, and that we're taking these saves straight to the bottom line. Okay. So it's a payback period of effectively roughly 2 years, but it's a permanent benefit. That
cost savings. And then the other component there is a further $1.5 billion, which I was looking at your earnings statement, and it was page 11 or 12, I think, of the strategic review. And the way you phrase it there is a reallocation of those costs into growth businesses. So I think it's a two-part question I have is, if you're reallocating costs, is that a net savings? Is $1.5 billion net savings? And what exactly are you looking at doing? Because there's not a lot of detail on that.
So the organizational simplification benefits, which are efficiency saves, not impacting revenue in any material shape, $1.5 billion, those will be taken to the bottom line. That's the first $1.5 billion. Now, additionally to that, we're also looking at what we do and recognize that there are further focus that we can achieve in our business, where we will be taking $1.5 billion from activities that we are currently doing that are either non-strategic or non-returning, and we will reallocate them. We'll reallocate these $1.5 billion as we materialize the saves. We'll reallocate them back into areas where we have competitive strength, where our customers expect us and need us to be, where we can generate good returns, and where we have greatest opportunities to grow. This second $1.5 billion, the revenue we will lose against it because we will be stopping activity.
Those units, those assets, yeah.
Those assets, we expect to be able to generate better quality revenue instead because they're more strategic or higher returning.
And have you told your team, have you given a timeline for that second tranche of?
Yeah, we expect to do it in the medium term, but there are a number of these initiatives which we already communicated to the market. For instance, about $300 million of this $1.5 billion will be delivered through our decisions around investment banking, in particular M&A and ECM in Europe and in Americas, where we're basically scaling down this activity. And others will come from other inorganic activities, such as the sale of our German private bank business, the sale of our French insurance business, Bahrain retail business, etc.
Looking at the timing of perhaps, and I know it's under review, so I'm not sure how much detail you could give at this point in time, but you mentioned a lot of those decisions will be made over the next few months. And correct me if I'm wrong, I think the timeline you gave was you want to complete the review by June of this year. When do you think you'll be able to make meaningful announcements?
So with regards to the efficiency saves, most of the announcements are done. The rest is execution. We will be able to talk to how much we've decisioned. But again, we have committed to achieve these saves by the end of full year 2026. So we're working on that timeline. With regards to the reallocation of costs from non-strategic or low-returning areas to strategic, areas of stronger competitive advantages and higher growth prospects, and obviously higher return prospects, we will announce as and when we have something to announce. So as I said, I've shared with you some of the ones that we've gone public with, and then the rest as and when we're ready to announce, we will make it public.
What's the message to employees, though, who I'm sure you understand and can empathize with? There's a level of uncertainty out there over job security. What is the message to employees? Well,
the first message to employees is a big thank you, because the momentum that we've been driving with this business and the results we've generated, as was communicated in February for our full year 2024, is the focus, the relentless focus of our employees and their focus on supporting our customers. And obviously a major thank you to our customers because of the trust that they placed in us to give us their business. And it's very important that we carry on this mission. Primary mission is to serve our customers. Customers are at the heart of everything we do, and then serving our customers remain a primary, unwavering objective for all our employees, whether you serve them directly or whether you serve other employees who are in turn serving those customers.
Is talent retention an issue at this point as you go through this painful but necessary process?
Yeah, so it's inevitable that when you go through similar organization simplifications, there are some roles, mostly at the senior level, where you have duplication and where at the end of the day you will lose some roles or some individuals due to the duplication of positions, mostly again at the senior level. So that is an inevitable outcome from such an exercise. But in general, we're a bank that highly values talent. We're a high performance culture. We want to attract talent, we want to retain talent, we want to train talent, we want to give opportunities to talent, and we want to be able to reward them competitively.
And a lot of the focus, I've covered your bank for many, many years, and you have a very, very strong franchise here in Hong Kong. In fact, it was strong enough that you decided to make it a standalone component and business line. And I'm wondering, are any assets in Hong Kong under review in terms of the wealth business or any of the assets here, or suffice to say, are these assets safe, or what's the best way to describe it? I'll let you say it instead of me speculating.
First, I'm very proud to say that we're celebrating this year 160 years of HSBC, and as you know, we were born in Hong Kong. We were born in March 1865 in Hong Kong, about 200 meters from here, and then a month later we had the first office in Shanghai. And then within a year, we had offices around the planet. And that's 106 years ago. And big parts of this region didn't exist the way we know it today back 160 years, and we've served our customers all the way through this journey for the last 160 years. Hong Kong is the heart of, is one of our two home markets, Hong Kong and the UK, heart of HSBC. We have customers that we've served for decades, if not for 160 years. We keep investing in Hong Kong. It's a major growth area for us. Hong Kong is on track. Well, Hong Kong is a global financial center, but is also on track to become the largest cross-border wealth hub in the world, sometime this decade. And we're a major beneficiary of this trend, and we're here to serve our customers in Hong Kong.
I mean, suffice to say then you're happy with your footprint, or if not looking to increase your footprint here?
Absolutely happy with our.
What about investment banking in Asia Pacific?
Absolutely happy with our investment banking in Asia Pacific. Look, for the investment bank, we obviously want to double down on all our capability around debt. That's debt capital markets, leverage acquisition finance, and other financing activities, because that's the heart of everything we do globally. And in regards Asia and the Middle East, we want to also double down our capabilities in M&A and ECM. So the exit that we're processing now in Europe and the Americas is to allow us to focus at the areas where we can really be differentiating to our customers, where we play to our competitive strength, and where we really bring value to the markets, to the economies, and to our customers.
And I think back to the point you were making earlier on, it seems the pivot is clear geographically speaking, and I'm wondering, do you have a sense of that reallocation of costs? Do you get a sense that those will eventually find themselves in units in the Middle East, in the Asia Pacific?
Yeah, so we're without giving specifics about how we're reallocating the cost, what I want to kind of absolutely hone in on is that any investment we do is subject to scrutiny and is subject to discipline. So where we allocate our spending and investment capacity and where we allocate our capital is going to be rigorously monitored at the top of the house. So we'll be very purposeful that all of these reinvestments are happening purposefully in a focused way in the areas where we can drive the highest returns, highest growth areas, and where we know we have competitive advantages.
Just to change the topic of the conversation right now, I want to get your thoughts on the macro. Does it look like the global economy is slowing down? Is the bank prepared for a world of lower rates moving forward?
So, look, I mean, rate forecasts have been changing literally every month. And
every hour sometimes.
Every hour sometimes, right. So it's very difficult to have a very clear view on where rates are heading, and that uncertainty is driven ultimately by the underlying outlook of inflation. Inflation is going to be an important driver of the rates outlook. And obviously inflation is going to depend on a number of parameters, including economic growth, but also considerations in global trade, such as tariffs and currency volatilities, etc. So, as you said, those forecasts do tend to change. A few things to observe. First, most of the geographies where we operate have governments taking pro-growth measures that support, growth and innovation, and this is a positive. Second, while we recognize there remains a number of uncertainties, in particular around global tariffs for the largest trade bank that we are, it's also very important to note that our customers' business continue thriving, and we follow them on their business needs across all the global corridors where they want to trade, where they want to sell, where they want to manufacture, where they want to partner. And we're along these corridors across, if you want, all our network, and we have one of the unique, broad and deep networks, on this planet where we can support our customers. And then we'll support them. We'll support them understanding uncertainties. I just want to touch on the rate outlook. Remember that we've also taken a lot of measures to reduce the dependency we have on rates for our own earnings. Firstly, we've taken structural hedging activities that limits the downside risk on our earnings from rates through our structural hedging strategy, which we've communicated about in detail over the last few years. And second, we're working very much so on growing the areas of fees and other income, such as wealth. Hong Kong is a great linchpin for that, but we demonstrated more than 30% growth in our wealth revenues in Asia in 24 compared to 23. And other areas such as transaction banking for our wholesale businesses are also growing in the mid-single digit, and we continue investing in these areas to give us growth in our earnings that are not interest rate dependent.
Is there a deliberate pivot to fee business over the shorter term, do you think, or are you?
I think we can grow in both.
Okay.
We will grow in the fee business areas because that's an area of focus and a competitive advantage. And then we will protect the downside due to rates, but we also want to grow the volumes. I mean, remember, we're a deposit bank at the heart. Most of our businesses run in the 50% loan to deposit ratio. Profitable deposits are a good demonstration of customers' trust in the strength of our balance sheet, and we want to continue growing this deposit base as well as growing our loan base as well.
I have a final question for you. September 2 was your start date as CEO. What's the one thing that surprised you the most about this job?
Well, first, it's a privilege and it's an honor to take this job and lead such a fantastic institution. And I think you'll always have to learn. I mean, I've been learning every day in this job. I expect to continue learning throughout my career. The one thing I remember is the advocacy. The one thing that really strikes you, or struck me when I was in this job, is the advocacy for our customers. Our customers really love us. The customer franchise we have is unique. Everything we do is about our customers. They're at the heart of everything we do, and we need to continue servicing them and serving them at the best of their expectations.